Bring that ass back like a boom, 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 boom.
Hey, good morning. What's up, everyone? Happy Sunday. This is Supernova, and you're with Boom Traders Weekly Overview. Today is June 26th, and this is the 25th week of 2022. And as usual, let's get going with the session overview. First, we're going to take a look at our risk vest model, then tactical trading environment as it pertains to our specific trading setups. Take a look at the current markets, and then we're going to take a summary. So the first thing that's important to note here, our risk vest model is on negative, and that's been the case since November of last year. However, we had a few minor buy alerts coming up throughout May, and most recently we had one this week. Now that triggered some long setups. You saw we did buy a couple. Some were working. BIOS specifically were working very well throughout this week. And as it pertains to the elements of the risk vest model, the general market is positive right now. You saw with the huge rally on Thursday and Friday. The up-down volume is positive. However, new highs and new net lows still remain on the negative side, with net lows being higher than the net highs. And stock participation is on neutral. Excuse me, as I said, a couple of groups have been performing stronger than the rest, with, as I said, BIOS and stocks located in China being really high on the deck for us. Now, our tactical trading environment signal is still on red, which means that the breakouts, the major setups that we are trading, are still not working well. Although, as I said, if you have been trading breakouts in Chinese names or BIOS and some of the beaten down names in Nasdaq, for example, they were working pretty well. So this is for the general market overview right now. So let's start with S&P 500, and this is my TradeStation setup. You know, I've been using this quite a lot. On the S&P 500, we basically hit this support right here at 363.12, which was all the way from 2020. You can see it right here. Double bottom right here, gap over, double bottom held, did not fully close the gap. You can see it right here, tiny little wicks to the downside. Tested it the third time, and then just though she rode. So this has been support. We tested it, hit it, bounced back, hot stove reaction, meaning that there was really some supportive reaction right here from the market, and we just moved higher again. Couple of gaps, same thing we will see with the Nasdaq. 5 days in a row upside movement, pretty good. And as you can see, we are probably gonna be testing the 50-day moving average right here, 405.81, which is the yellow line. There will be some volume waiting for us right here, although on the way down we just move straight through it. But if you are a fan of volume profiles, you will see some high nodes right here around 390, 395. Anyway, I'll take it. This is a fast zone. There is no resistance, absolutely no support anywhere around here. We just, if you can see those lows, we just gapped under them right here in the S&P 500, which to me was very climatic action to the downside. So S&P 500, I would say some consolidation right here would be okay. We did see a follow-through day, legitimate follow-through day here on the S&P 500. Volume was light to my liking. I would prefer a move above the 20 or the 50-day moving average for the volume. I'm using a 20 right here, but anyway, I would like to see volume really elevated on the follow-through day. So although price action was very good, you can see this one closed dead on the top of the candle. Volume was not as elevated as I would like to see it. So we can put it as a follow-through day, but just have in mind that this volume occurred in the last hour of the trading day, so it might not be as significant as other follow-through days that we have experienced. Nasdaq, pretty much the same thing. 5 days in a row, positive action, and right here, look at the volume. Volume is very low. This did close again at the top of the range, but volume was very light. So although we are putting this as a follow-through day, we're still looking for some more volume to come in here with the buying. Although, of course, understand that since the Feds are now in a QT type of environment, it's going to be hard to find that liquidity in the markets poured in like a couple of months ago when we were still in quantitative easing. Anyway, target right here, yellow line 305, 42, and right here it will coincide with the volume node on the volume profile if you are a fan, as I mentioned. IWM has been one of my favorites so far. It definitely looks stronger than S&P 500 and the QQQ. As you can see right here, we did actually have a valid follow through with volume above the average, so this looks much better. Again, target is right here, 182, and one thing I also want you to note right here, if we hit this target on the 50, that will be head and shoulders formation. So if we break this on volume to the upside, our target will be the head and above. So move above the 50-day moving average will be confirmed by this head and shoulder break right here. So that's for IWM and Dow Jones Industrial. Definitely the stronger one. You will see in my notes of all this of the four indices. This is you'll see it has recorded the least least drop for since the beginning of this year. And although we had a huge move on Friday, volume was still low, but as you can see, it has been pretty much acting well compared to the market in general. So this is for the overall look of the indices. Now let me take you through some of the market internals like advanced decline, put call ratio. I want you to have a grasp of them, and then I also show you my two indicators that last week were suggesting bounce for this week, and I will see how they read right now. So without further ado, let's take a look at the advanced decline line. Now looking at the advanced decline line, I'm going to leave the screen set up like this. Basically you have the S&P 500 on the top, QQQ right here at the bottom, Dow Jones, and here on the right side of the center screen, that's the IWM, the Russell. So let's first start with the S&P 500. This blue line is the advanced decline line. You can see it's following very closely with what price is doing, no divergences whatsoever. So we are basically in good shape. And those two indicators, price action and advanced decline line, are showing the same thing. Now at the bottom you can see the 52-week highs and lows. We are still in red territory, meaning that more stocks within the S&P 500 are making 52-week lows than the stocks that are making 52-week highs. So that generally speaks for weakness. When we have such a powerful rally as we have this week, these 5 days, I would like to see a little bit more in terms of net new highs, net new lows, but nevertheless, you can see right here, I think on Friday, we might have recorded a positive day in terms of that indicator. Now, QQQ, basically the same story for the advanced decline line and the price. They do basically speak the same language, moving side by side, so this is good to see. And net new lows are dropping. Unfortunately, net new highs are not going anywhere so far, but you can expect that since the market has been beaten down, especially in the Nasdaq, for so long and so hard. IWM here at the top, you can see net new highs are starting to creep up. So basically, we're having some positive development here in the IWM, and as I said, it's stronger than S&P 500 and the Nasdaq at the moment. Advanced decline line, same thing, no divergences, so all looking good here, but IWM had really a follow through on big volume. Dow Jones Industrial, this is the strongest, as I said, of all the indices. Then you can see there's a divergence between the advanced decline line and the price of Dow Jones. So basically what I'm thinking here is just the market is pushing down the price lower, but the stocks within the Dow Jones Industrial are showing very good relative strength. Now, put call ratio. Put call ratio is important when it moves above 1. That shows extreme hedging in the market. That means that puts are more than calls, and market is afraid. Now, I noted that we had the put call ratio moving average moving above 1 which is an extreme reading and usually signals a bottom in the market or some bottoming action at least. So this is one of the indicators that I'm using to see when the market is close to reversing. Every single time we get a spike to above 1 or above 1, as we saw right here, that definitely signals that there's extreme fear in the market. So the first thing that I'm looking for as my market timing indicator is the stocks above their 20-day moving average. This is this green line. I have two levels, of course, 20 and 80, 20 being oversold, 80 being overbought. And these are the hard oversold and overbought. 70 and 30 are the soft overbought and oversold. Then I have an indicator right here, which is a basic oscillator. And every single time this oscillator moves between, that's stochastics, I'm sorry, I just called it an oscillator, but that's stochastics really. So every single time we have our oscillator in an oversold condition and the stocks above their 20-day moving average for the entire market, the entire United States market, being oversold as well, we do see a bounce in the market. Now, here's a couple of things that we need to look for. Now, the first thing that we need to see right here is already happening with the stocks above their 20-day moving average moving above our soft oversold level at 30. So right now they're at 30.7%. That's good. Now we need stochastics to move from this oversold zone and starting to go up and at least see it at least until the 50 zone. So the mid zone of stochastic. We want to see it there for a powerful rally. So that's indicator number one. The other indicator that I'm using, and I have to switch screens here, so let me just try to make it right. That's supposed to be, I think it's number one, no, number two, yep. So the other one that I'm using here is an indicator that I've based on the advanced decline line. So let me just maximize it for you. So this is the S&P 500 on top. This is Thinkorswim. There are different market internals that I can use on TradeStation and Thinkorswim. So Thinkorswim has some other tools that TradeStation don't have, and the other thing is that I'm very good at coding Thinkorswim, not so good at coding TradeStation. So this is the other indicator that I use with data from advanced decline issues, and every single time we hit those two green zones there, they're at 1,200 and 2,100. We do seem to get a bounce with extreme oversold condition right here in 900s, and now we're approaching the upper zone, and this also coincides with some other tools like the retracements, like Fibonacci's, like, as I said, 50-day is coming up right here. So you might be actually looking for, after such a long extended week, and if you look at the weekly chart, let me just put it up on a weekly chart. You see the weekly chart, you're having like an incredibly huge bullish bar. So after such a huge week, it's normal to see some consolidation. We see it right here. You saw how it reacted. You saw it right here, small follow through. You saw it right here, small follow through. So after such a long bullish week, it's a good idea if you can scale some out. But anyway, this my indicator was right here last week, the end of last week, and I said, all right, well, this is in the very oversold. My other indicator on TradeStation, we're just looking at, is it this? Yep. My other indicator on TradeStation was also very oversold, and that was right here last week. And also we had the put-call ratio, as I said, we had the put-call ratio, which was right around here. So all of this suggested that the market is very, very extended to the downside, and we might have a bottom. And I was a bit aggressive this week buying stuff, especially in bios. So it's been a good week for me. But now I'm expecting some slowing down, and I think that you should be careful with further buys. At least let the market show you that we're continuing this same trend. So this was for the internal, this was for the charts in terms of the indices and so forth. Now let's take a look at some of my notes. It's been an interesting week with a lot of action from the Feds and European Union with Ukraine. So let's take a look at some of that, and then we're going to talk about industry groups and sentiment. The first one the first item that I have in my notes for today's session is the year-to-date returns through mid-June for the S&P 500, Dow Jones, Nasdaq, and Russell 2000, and compare it with history. So for the S&P 500, minus 23.1% drop. This is the second worst in 94 years of history. Dow Jones minus 7.6%. That's the fifth worst in 122 years of history. And as I said, Dow Jones is definitely outperforming the other three indices. Nasdaq and IWM, you can see worst in 51 years and worst in 44 years. So the year-to-date performers for Nasdaq and IWM has been the worst in history. S&P 500 second worst in history. Dow Jones fifth worst in history. This week was pretty much, scarred by a couple of talking points that the Feds came up with, and I have three quotes right here that I think are going to basically give us a clue how the market is going to be going forward and what the Feds are going to be looking for in order to either keep on with the rate hikes at the current rate or try to start and slow down the rate hikes. So the first one is I want to move up rates to 3.5% this year. That's from Bullard. Front-loading rate hikes, is a good idea in this situation. And once more, he says, once disinflation dynamic starts to take hold, Fed could lower policy rate. So basically, they're gunning for those 3.5 this year. But if CPI numbers come up good, or at least start to decrease, so inflation start dropping, we might see the Feds actually starting to hold on to the rate hikes, or at least rate hike lowly. So to me, that definitely ties into this particular slide. You can see how the market's been reacting when we're having some tightening to no tightening. So the market's just rallying off if there's no tightening, definitely. If we have a slow tightening cycle, you can see right here with that's dark blue, we are basically still moving higher but at a slower rate. And if we have a fast tightening cycle, that can definitely just kill the rally. Now this is a chart comparing this bear market to other bear markets. I'm not going to go into this. This was in the last couple of presentations. So this was the important one. If we have a fast tightening cycle, the market really reacts and that gives up the rally. Whereas if we have a slow tightening cycle, we still move higher but on a slower pace. And this is what I'm expecting for the market if, of course, the Fed rate hikes do have the effect that we all want to have on inflation. Last but not least, a couple of notes I also wanted to point out here. The first one is that when we're looking for our models to see how the market might move on from here on, we're taking two timestamps in history for precedents. This is 1962 and 1990. And according to them, the S&P 500 probably should have bottomed right here, and we are going to see higher prices year on now till the end. For Nasdaq, we do have a rally right here, but then we have another drop that will undercut the lows and then move higher. Now, again, we cannot basically trade on the cycle models in general, but I'm just telling you what they're suggesting. Of course, another issue that has been on the watch right here is Ukraine, and Ukraine has been sort of fast-tracked for the European Union membership application. So within 4 months, that's an unprecedented speed for the European Union. Ukraine's application to become a member state of the European Union has been moved forward. Now, this doesn't mean that Ukraine is a member state of the European Union just yet, but it's saying that the European Union is united in its effort to accept Ukraine to the European Union. And that hit the news wires this week, so we are yet to see what will be the response of Russia, but mind you, that might bring some further instability in the region, and of course the market might respond to that. a good thing that is happening in the market, it's a good development that is happening in the market, is that some of the commodities prices are dropping, like copper, like lumber, and most notably like oil. You can see most of the oil and energy stocks have been decimated for the last week and something. So that's definitely a good thing because it's going to bring down some of the pressure from the stock market. As far as sentiment is concerned, this is the American Association of Individual Investors, and this still hasn't updated to the latest reading. I think right now we are at the 41 minus 41.10, which is one of the highest, well, in terms of highest bearish or lowest bullish reading that we've had pretty much, I wouldn't say all year, I would say like a couple of years back, but we only undercut it once right here, minus 42.92 a couple of weeks back, but right now we are back. And with the recent development through Friday, I think that this is going to bounce a little bit, but you can see the extreme pessimism that we had at the beginning of the week within the sentiment and the individual investors. CNN Fear and Greed right now is updated, as you can see right here, in June 24th. To a level of fear which is 28, but you can see 1 week ago it was extreme fear at 14. And if you see the timeline, I timestamped it right here on the May 12th. We had 7, which is extreme fear, and that was the lowest reading for quite some time. Well, at least for 2 years that was the lowest reading. Right now we're moving back up, which is a positive sign. So you can see even in Bitcoin, fear and greed index for the Bitcoin, when Bitcoin was at $19,000, the score was 6. Right now we moved back to 14, which is still extreme fear, which is good. Meaning we need extreme fear for market rally. We need to be very fearful when the market rallies and people start buying. That's the way it just works. So we had this extreme fear now at 14, but it was 6, so it's moving. Up. And now this is what I have for sentiment. Pretty much everybody is accepting the fact that we were at extreme fear. Sentiment readings and bearishness was predominant in the market. Now with this week developments, things are starting to move a little bit up. Even some of the very, very, very famous investors are starting to buy up stock. Most notably, Warren Buffett was scooping up some Occidental Petroleum, Oxy stocks. But there were also other more aggressive investors in the innovation space, like the Nasdaqs and the ARGs that starting to buy aggressively. And this is what we saw with the Nasdaq, and especially those beaten down tech names that started to pop throughout this week. Also, I wanted to note that, and I forgot in my notes, China had some decisions regarding Alibaba's IPO, and it was coming up with some positive news that they would actually allow this IPO to happen, and they are okaying Alibaba's venture into this business. So this definitely lifted some of the Chinese stocks, and they were, as I said, with bios on the forefront of this week's rally in Nasdaq and innovation technologies. So now let's take a look at the industry groups, and I'm sure we're going to see some interesting things that are setting up for this week. Now what we're looking at here is the interface of Market Smith. That's from Investor Business Daily, and we will be looking at this column right here. You see it right here. So we're looking at this column right here to the downside, industry name. So every week, as you probably already know, Market Smith is coming up with the Market Smith Growth 250. That's a list of the stocks that they are recommending. And every week they have additions and deletions, and by sorting out the industry name right here, we can basically see what's lining up to be with higher relative strength, what's good to buy, and then with the deletions we see what's dropping in terms of relative strength and what's not following the market. So let's take a look at this column right here. We're not going to look at specific stocks right now, but we need the groups. As you probably know, indices, the market, of course, 50% of all stock movement is within the market, then at least 30% is from the specific group that the stock is coming in from. So we need to know what are the strong groups. And I just look for some patterns, some groups that pop out more than others. So we have beverages and alcoholic with three names being added to the growth list. We have computer software, that's design software, medical software, security. So basically, computer software is popping in. You see here CDNS, NS Synopsys, EVH. That was a good company to trade. We have some finance property with four of those being right here. Insurance. We have three, and you can see medical, biomed, biotech, as I said. Harmony was a good trade. Yeah, this one, RPRX. This is one still setting up. I think can be traded. You can see medicals also. Pfizer. Medical managed care. So medical was basically a theme for this week, and pretty much that's it. I think medical, finance and right, and computer software are probably the three top that were added. And now if you take a look at deletions, I'm just going to do the same thing right here. By industry, you can see what's going on with oil. It was just decimated really for the last 2 weeks. You can see like oil and gas exploration, refining, integrated. We have a huge section of stocks that have just been removed. And yeah, that was just it. So oil and gas, finance and investment bankers, just two energy coal, AMR Arch, no surprise they're removed. Huge drops. So basically oil and gas, as I said, have been just decimated, and they've been moved out of the Crow 250 list, which is actually 300 stocks. They just have it, and they just call it 250, but it's actually 300 stocks. And for the summary, I just have this. So our risk vest model is still on negative, although, as I said, we've been seeing some buy signals this week. So we might try a few names. Setup. Selective. I've moved it from very selective to selective. You still have to exercise caution. It's not like everything is working, but it's a good market to try some. The market is in bounce mode, and the bounce right here is in red, just because we are still not clear if this is bear market bounce or it's just putting on the bottom. It's starting to move out of this. The put volume is coming down to neutral, as we saw in the put call ratio. Volatility is neutral. It was elevated for the first couple of days, but then it dropped. And in terms of other issues, I don't think that I'm going to be changing this anytime soon. We have the rates and the inflation, they go hand in hand. And then we have war, which is actually causing spikes in some commodity prices, which is causing inflation, which is causing the rates. And though we have this circle. So in last, just try some. Get there, try some, put in some small size. Don't go very aggressively. Put in some small size and see if it works for you. If we see some follow through on volume this time, that will be really positive for the market. But again, remember, we have resistance coming up from the 50-day moving averages on all of the indices, plus some retracements and horizontal resistances. So be careful. But again, as I said, try some. So that was it for this week. I hope you guys liked it. If you do and you're still not part of our Discord server, please come and join us. Subscribe here in YouTube, like, share, and safe and happy trading next week. And I'll see you here again next weekend. Bye bye.